Now I'd like to welcome Marc Rowan, CEO of Apollo Global Management, to the stage. Thank you so much for joining us this morning.
By the way, the seat is still warm.
Literally and figuratively.
All right, well, there's a lot to get to. We obviously covered a ton with Mr. McHenry, but you sat down with me a little over a year ago, and the political and economic environment was in a totally different place. We just talked to Mr. McHenry about bank failures, how Congress may look to regulate. We were talking backstage about the confluence of the real estate, banking system, kind of how fragile the economy is. How do you see the current environment from your vantage point?
Such a broad question. Current environment. Look, we're having a non-recession recession. Typically, we think of a recession as lots of people losing their job, a fall off in demand. That's not what happened. If you wind back in history, since 2008, we've printed $8 trillion. What did we think would happen when we printed $8 trillion? Well, exactly what was supposed to happen happened. Everything went up. Who benefited from what went up? People who own stocks and bonds and real estate and hard assets. Most of the country did not benefit from that boom. Most of the country is not suffering from that correction. People have jobs. The downfall or the recession that we're feeling is among asset owners and among what's happening in the financial system. It doesn't make it less important, but it's a different type of recession than what we've had previously. So for most people, it actually feels pretty good. If you're on a coast and you're near a news media and you own lots of assets, it doesn't feel so good.
Now, you heard a lot of what McHenry said about what Congress might do, might not do. What is your view on if you could have a priority list for him right now, what would that look like?
Look, I started where we started backstage, which is we're not asking the right question. So I look at how much money we've thrown at semiconductors because it's a vital strategic interest for the United States. We are the envy of the world. We're half the world's capital. Our consumers benefit, our companies benefit, our government benefits, our allies benefit. People come here to raise money. It is a massive strategic competitive advantage. By the way, lots of employment too. We can fiddle with that and we can destroy that. Or we can step back and say, what is it we're trying to do? So there's nothing he said that I would correct in terms of the diagnosis of what happened. But what do we want to happen going forward? Do we want a system that is a Europeanized system where we have 4 large banks? Or do we want regional banks, community banks, local banks, market participants, where we have a diversified financial system which is actually a source of our strength rather than a source of our weakness? So small ball here is actually quite dangerous. Dodd-Frank worked. It doesn't mean it was perfect, but it actually diversified the US economy away from dependence on 4 banks. Right now, banks are less than 18% of all the debt capital provided in the US. Who are the new bankers? All of you. Investors are now the new bankers. They provide most of the debt capital. What's happening now? People are fleeing small banks, regional banks. They're all going to JP Morgan, Citi, B of A, and Wells. Some actually think that's a desirable outcome. Others do not.
You don't, it doesn't sound like.
I think that we've already seen that movie. We've actually seen what's happened in Europe. This is the European market structure. There is no capital market in Europe. There is no capital market in China. They rely on state banks. State banks are small in number and are politically influenced and actually carry out government policy in the way they lend money. If that's where we want to end up, we should continue doing what we're doing, which is herding money to 4 banks. If we want a diversified system that is the strength of what I think we are, we should figure out how to make regional banks and others successful.
I want to ask, you heard Mr. McHenry be a little critical of the fact that the government didn't open its aperture, if you will, in terms of who the potential buyers of Silicon Valley Bank look to non-banks and others. Maybe explain a little bit for those who don't know in the audience, what is Apollo? How is it different than a bank? And what role might you play in a bank failure, if any?
So we are an asset manager at our core. We are also a massively large retirement services business, which is an insurance company, basically. So the business, so you have a quick description, 550 billion of assets under management, 400 billion of that is credit, mostly investment grade, mostly the kinds of things that banks used to invest in. $75 billion is hybrid capital. Think of that as capital for infrastructure and projects. And $75 billion of that is private equity. So the vast majority of what we do is credit. And most of that credit is private investment grade, similar to what banks used to invest in. The difference, we fund ourselves on a very long-term basis. Our clients are pension funds, endowments, retirement plans. And so whereas banks borrow short and lend long and need to be attached to the Fed, we borrow long and lend long. That is, I think, for us and for the market, a more stable structure. We don't have the kinds of runs on banks. There's not been a run on an insurance company ever, including in 2008 with Genworth and AIG. It's just not how people think about that amount of money. So the aperture you're talking about, we are a buyer of assets that are the kinds of assets that banks originate into long-term sticky funding for the benefit of insurance companies, retirement funds, and pension funds. We also happen to be private capital. Some like private capital. Some don't like private capital. My team, who took a look at SVB, I told them 2 weeks ago, you are not going to end up as the buyer of these assets. It does not matter what price you offer, you are not going to end up as the buyer of these assets.
And why is that?
My own sense is that the current regulatory climate is such that anyone but private capital seemed to be the solution that was being searched for. They found a solution, all good.
But besides the politics, you did take a look, right, in these kinds of situations as a buyer of assets, right?
We are a buyer of assets, but we are not a bank. We don't take deposits. We don't have a nice 100-year-old building on a main thoroughfare. We don't get the benefit of government guarantees. We don't get to go to the Fed. We are a long-term source of capital. We match investors with assets. And everyone in the world needs safe yield. Banks historically have been really good providers of safe yield, but I'll be provocative with you because I did listen to your interview. I think you missed asking Mr. McHenry a question. Not whether the crisis is over, but what is the future of banking? Think about what just happened. In 2008, 2009, WAMU, the last time we had a bank run, 18 billion left WAMU over 10 days. 42 billion left Silicon Valley Bank in 4 hours. 100 billion left Credit Suisse in a day. If you are the CEO of a bank, any size bank, can you lend money today? That to me is the question that needs to be asked, which is what is the business of a regional bank, a super regional bank, a small bank, and a community bank once things are stabilized? Because we're not stabilized yet. People are nervous. There's no upside in banking. The best you hope for is getting your money out. The moment you hear anything, you go to JP Morgan, you go to Wells, you go to Citi, you go to B of A, figure it out later. And by the way, that's probably what all of you in this room did also. I had a few at breakfast who admitted that to me, that's exactly what
No comment.
did. Exactly. Or as they say, I resemble those remarks.
But I mean, you raise an interesting question. I mean, a lot of people go to regional and community banks because I think for altruistic reasons, they want to be part of a community. They want to help local institutions. Also because of service. I mean, First Republic and Silicon Valley Bank do things that perhaps JP Morgan or Citi won't do for you. So what is, in your estimation, what is and what should be the role of these medium, small community banks?
I start at the big picture. Our financial system is a strategic advantage for us. We are the envy of the world. It is fully diversified. Banks play a relatively small role in the context of our system versus every other system around the world. We can have 4 banks. That is where we are heading. They have a cost of capital advantage. They have a funding advantage. They have a perceived stability and safety advantage. And all of us in times of crisis move our money right there. Why should a regional bank before this crisis had a funding disadvantage? They always paid more for their money. Are we going to have more or less regulation of regional banks on Tuesday? More. It may be different than any of us. That's going to be a cost of doing business. If you're an investor, are you going to put more your money into the equity and the debt of a regional bank? No. And so how are you going to make these successful? You're going to have to come up with a system where people perceive all banks as being equally strong. There's not just one way to do it. It's not just about deposit limits, but I think Representative McHenry was saying the right thing, which is it was access to the window. But the business of banking is going to need a careful examination once the dust settles.
How do you view the current regulatory environment, right? We're just starting these hearings that Jake was bringing up earlier, the idea that the FDIC and deposit insurance should be raised over $250,000. Are there things that you would support or that you think would help shore up, to your point, the idea that there isn't just for big banks, but there is a viability for a multi-dimensional kind of banking structure?
Look, I think there is not only a viability, but there is an essentiality of a multi-dimensional banking and funding structure in the country. But what I think is not relevant. We have a divided political consensus. There are some who think a Europeanization of our financial markets is the goal. That results in 4 big banks, that results in a less dynamic market, but it's probably one that's easier to regulate and to control through non-regulation. There are those who think that the community service aspects, the diversity of funding is actually a strength. How that plays out is the current debate. But one has to, and I think Representative Henry did a really good job here. Financial institutions die from one of 2 causes. They die of heart attacks or cancer. Cancer is the making of loans or the buying of assets over a long period of time that gets you in trouble. Heart attack is a liquidity mismatch. We just saw SVB die of a heart attack. $42 billion left the bank. It had nothing to do with their assets. So as we think about regulation, there is actually lots of regulation on the books to deal with cancer. We're very focused on asset quality. We're very focused on capital. We have not historically been focused on funding structure because a bank run of this magnitude has not happened. But we're not going back. The world that existed in 2008 is not the world that exists in 2023. 42 billion can leave the bank in 4 hours, and if you told me it was 150 billion, I wouldn't be surprised.
All right, last question. The Fed has continued to raise rates despite the 2 bank failures. Where are we when it comes to, you said a recession, not recession, but do you think the government is tinkering too much with our national financial system?
Look, I'll give you what I think the end result is going to be. I think we're still in the midst of bank instability. I fully expect there will be an intense focus on commercial real estate. Banks, fortunately, don't own commercial real estate equity, which is going to suffer very severely. Banks are generally prudent lenders of commercial real estate debt, but make no mistake, banks, regional banks, own lots of commercial real estate debt. Couple a funding crisis, which we just had, with a commercial real estate lack of confidence, coupled with the discussion you were having about raising the debt ceiling, I would doubt rates get higher.
You think they'll cut rates
Me personally, I think rates will be cut
this year?
this year.
All right, we'll end it on a newsy note. Mark, thank you so much. We really appreciate your time this morning.
Always fun.
All right. Thank you all for joining us in person and on the live stream for this great conversation. Big thank you to Patrick McHenry's team as well as Apollo Global Management for their partnership in this series. We have a lot of other events happening in the coming days and weeks. You can check out our events hub at punchbowl.news. Have a great day.